Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today's Monday. It's March 6th. I don't know where the year has gone, but we're almost a quarter of a way done, if you can believe that. It really is mind-blowing. It's about 7:30 in the morning. The market's not going to open up for 2 hours, to be specific with you. I wanted to get a nice early start to kind of get the basis and cover everything that's on this week. Now, I want to show you the calendar this week. Notice Powell speaks. Powell speaks. Boy, God bless this guy, but anytime he speaks, he just doesn't say the right thing for the market. He really doesn't. I honestly wish he just wouldn't speak. I honestly just wish he would post a report. But in terms of data this week, you got factory orders. You got Mr. Jerome, I'm not going to tell you the truth till you reappoint me, and then maybe I'll tell you the truth if you twist my arm. Powell speaking. And the biggest report this week is going to be the employment situation. Now, the employment situation is very squirrely because Fed data has been fairly strong, and when Fed data is fairly strong, it kind of gives the Fed a license to raise rates, which is not very good. Today we have factory orders, and I'll get into all of that as well. Also, Apple got upgraded. We'll get into all of that. Now, the market has been going up the last few days. I want you guys to know that. And it's very, very hard. Notice we're kind of mixed right now. The futures on the S&P are down 3 points. NASDAQ is up. This is just total randomness. I think the market is waiting for factory orders and for Powell to speak. And I also think the market's a little bit tired of the non-certainty we've been seeing. Now, the best thing I could tell you two things today that could actually make a difference in your trading. Not two things, but a few things. First of all, bonds are rallying. Now, notice the bond market, right? Notice this bond market pattern, right? Take a look at this. And now take a look at the Dow. How different does that look to you? See, broke down, went above, algos right here. Lower, low. I warned you about that one many times. But notice it's mimicking each other. The Dow is literally mimicking. Look, that's the Dow, and that's the bond market. That's the Dow, and that's the bond market. To say that they're highly correlated right now would be a big understatement. They are extremely correlated right now. So we got to be very, very cautious, and we got to pay very close attention to the bond market. Now, as far as data, and there's a seasonality that's going on this week that I need to tell you about. It actually started last Friday, but I'll get into that after this. So market participants are awaiting testimony from you-know-who looking ahead to Friday's U.S. payroll report. Now, that's going to be the big report this week. And remember, earnings are pretty much behind us. And the EPS and the earnings expectation curve looks like this. I mean, it looks nasty. It went from negative 1.5% over the last quarter to 9%. So nothing is good going on there, but there's a silver lining, and the silver lining is that the small caps did not move south as a result of the earnings report. On the large caps, that's a very, very that's a very strong clue that we may in fact be bottoming out. In Friday's session, the tech-heavy Nasdaq and the blue chip notched a 2.5-week high as Treasury yield retreated from key levels, with 10-year Treasury yield pulling back below the crucial 4% level. A decline in Treasury yield bolstered a rally in interest rate-sensitive stocks like financial, consumer discretionary, and technology. Data on Friday showed that non-manufacturing PMI stood at 55.1 in February, stronger than expected, with new orders and employment climbing to over a one-year high. Now, you may think that's a good sign, but the problem is the Fed will use that against you and say, hey, economy is growing really firm. We can throw more at it. So you got to be very, very careful with that right now. U.S. services PMI came in at 50.6 in February, above expectations of 50.5, returning to growth for the first time in 8 months. Again, that's a very positive sign. But how will the Fed react to that? Well, let's find out. Boston Federal Reserve President Susan Collins said Friday, U.S. central banks need to keep raising rates to combat high inflation. They're telling you, they're being straight with you. They learned their lesson. At least some of them learned their lesson. I do believe, she says, we will need to do some additional rate increases, and exactly what the right amount really needs to be dependent on a holistic review. Oh boy, when they start talking about holistic reviews of information we receive, you know the party's over. Also, San Francisco President Mary Daly said on Saturday that the Fed would likely need to raise rates higher and keep them there longer, which is exactly what I've been saying. And a lot of the Fed's been saying that too. It's not new. You're not hearing this for the first time. This is not a shock. In order to put this episode of high inflation behind us, further policy tightening maintained for a long time will likely be necessary. They're telling you exactly what they're thinking. Investors will focus on congressional testimony from Federal Reserve Mr. You-know-who for fresh insight on the Fed's rate hike path. Powell will testify before the Senate on Tuesday and the House of Representatives on Wednesday, which means we got to put our helmet on. We got to put our defensive helmet on because whenever he speaks, markets usually go you-know-where. And the fact is the markets have been going kind of up. It's been kind of difficult to generate trades because I like to buy when markets are lower, not higher. It distorts the option premium. So I could use a couple of good days to the downside if you want me to tell you the truth. Nothing crazy, just a little bit of a consolidation would be good. Today we're looking at factory orders in less than a couple of hours. I think it's coming out at 10. Actually, no, in a couple of hours. A little less than 2.5 hours. They were correct. And they're forecasting the factory orders to be down 1.8% for the month compared to last month's value where they were up 1.8% for the month. In a nutshell, they're not looking for the numbers to be all that much higher or lower. Europe, investors digested China's conservative annual growth target, as well as Eurozone retail data. Now, Christine Lagarde, I really like Christine Lagarde. She's a very smart lady and she doesn't BS very much. And it took her quite a lot to get elected. I'm going to tell you that. So she's someone to watch. And I read an interview with her. She doesn't mince words. She says very likely Europe's central bank will raise rates by 50 basis points this month. Now, she's no Powell. She's not Powell. She's the opposite of Powell. She actually means what she says, and she backs it up. If you guys have a chance, listen to a 60-minute interview that she did about a month ago. Yeah, about a month, maybe 5 weeks ago. It was very good. It was really good, and it was very clear, and it kind of gives you a background of where she's coming from. China. Now, the best part about China is this. I haven't heard anything about COVID now for quite some time. Very, very positive. They're going to be opening lower after leadership set a weaker than expected target of economic growth of around 5%. Also, they expect the GDP target of 5.5% for 2023 as they emerge from 3 years of COVID disruptions. Now, it's horrible. It's terrible. But here's what I'm going to tell you. I'm not hearing anything about COVID, and stocks that were reacting to COVID are now not. For example, airlines, casinos. It's good. They're starting. United Airlines is starting to come up. Not certain about cruise ships just yet, maybe, but casinos, Wynn, Sands, Wynn, Sands, Mirage. They're doing really, really, really great. Mirage is Wynn, so MGM, Wynn, and Sands are doing really good. You should check out those stocks. I may actually go through some of them. Apple got a little upgrade from Goldman Sachs. I think that's a very bullish sign for the market, especially right now. I'm going to have to read that, but honestly, the fact that they're upping rating on Apple, and Apple has 20% of market cap of the QQQ, that's a pretty good sign. It'll be interesting to see what happens. As far as earnings, Ciena's coming out with earnings, but the good stuff is behind us. Everybody in the S&P has reported. The retail sales data is out. There just isn't much to influence the market in terms outside of the Fed. Now, look at the Dow Jones. If we break the 50-day moving average to the upside, which is right here, which is at 33,500, there's a good chance we'll go to the upper end of that range. There's a good chance we'll go to the upper end of that range. If, in fact, we can't break this data, then we will succumb lower. Now, I'm practically looking at NASDAQ 100, and we broke past that level. And if you look at the SPY, we also broke through that level, and we bounced off the 200-day moving average. But honestly, and I'm telling you this in good faith, unless I see the SPY go above this level, this threshold level right here, 415, just don't think we're going to make it. It's going to be very, very hard to say, and you got to keep your eye on the bond market. You got to keep your eye on the bond market. If the bond market fizzles out, and if it starts going down, goodbye, Charlie. You ever heard that saying? Bye-bye, Charlie. I had a dog named Charlie, so goodbye, Charlie. A long time ago when I was in grade school. Anyways, looking at sectors, and I want to show you the sectors and show you kind of what's going on. We're still getting love from technology and communication services. Consumer discretionary is only one away from them now, only financial stopping it. These three babies have to come together: technology, communication services, and consumer discretionary. And they usually come together as the market cools off. But the market doesn't really have to cool off very much for them to be together, because the only thing apart here is financial. I want to show you a week ago how it looked. Look at consumer technology. You had consumer staples in between. 2 weeks ago, a month ago, you had consumer discretionary all the way at the bottom, and communication services, this is January 24th. Technology was up here. Now, that's 27 days ago. Now, they're not that far apart, and they're all down here. They're not up here. Notice basic materials, industrial, energy's coming back. Technology and communication services really doesn't belong there, and now that earnings are down, I think we're going to come down a bit. Looking at them individually, which is something we need to do, basic materials is looking really strong. Industrial is killing it, and I told you it would. Energy's definitely coming back, and if anybody wrote out energy, don't. Energy's going to remain in play till this inflationary environment is over. Be very, very cautious with technology right now. Really cautious with technology right now. Be really cautious with consumer discretionary. Consumer discretionary looks like it could just top out right here. Especially earnings are finally behind us. And notice it didn't really break above that level, like the QQ. Look at QQQ. Broke above, and now look at consumer discretionary. Did not break. So be very cautious with this right now. Let's go back to the sectors. Consumer staples looks like it's trying to build a base here. Utilities looks like it wants to rally a little bit. Healthcare looks like it's got maybe another day or two to go before it succumbs. This trend isn't strong, but I don't really see why healthcare took a downslope, unless a lot of people took money out of healthcare and put it in technology, but that will reverse itself. Real estate, I'd be really cautious right now. The sectors that I'm really liking right now, I like financial, I like basic materials, I like industrial, I like energy. Technology, I would be really careful right now, and I'm starting to look back at consumer staples. If you look at the momentum levels, you will see that consumer staples is really low right now. Utilities is really, really low right now, and I'd be cautious. Real estate, see, the problem with real estate is you have less stocks making a 200-day breakout than you have 50 days. So you got to be really, really cautious with that. Consumer staples, on the other hand, almost 50% are above the 200-day, but only 24. So I like consumer staples. I think utilities may bounce a little bit. Communication services, technology, be very cautious with those stocks. Be very, very cautious. Now, I want to tell you something interesting. Starting Friday afternoon, let me put this here. There is a seasonality. There's a seasonality that favors gold coming down for the next few days, and also this stock here. It's a freebie. I posted this for you on Friday. We got into it Friday afternoon. It's already down 1.69% as of Friday. And we're going to get out when it takes out the low. It's the opposite of our rule to the upside. But I'll be giving you more of these seasonality trades on my Telegram channel. I've been giving 3 and 4 already, and we have 4 winners for 4 winners. Subscribe to our Telegram channel. Get some of these freebies before I launch the service and charge you an arm and a leg for it. Be very cautious. Listen to what Powell says. Most importantly, listen to how the bond market reacts. If the bond market takes off, there's a great chance that Dow and other stocks related to the Dow will take off as well. We got to be very, very cautious, though, because I believe we're going to see some downside in consumer discretionary, in technology, because earnings are behind us. Here's consumer discretionary. Here's communication. Just not seeing a lot of love out of these stocks. I'm just being realistic with you. Although technically they don't look that bad, I just don't think they have what it takes. And with Powell speaking, and Powell, interest rates, the Dow correlation, be very, 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 very cautious. This may be a week when we have defensive stocks going up. Now, I think I gave you a pretty good week review. And if you're enjoying this, please subscribe to our channel on YouTube Wealth Press channel. The links that I'm about to talk about are below that video. Now, something shocking is about to happen on Wall Street, and it could result in a big cash flood on record in the U.S. stock market. Investors have more than $4.5 trillion in cash stashed inside money market accounts right now. They're waiting for the right time to buy the market. I don't blame them. I honestly agree with that. A lot of people are sitting there on the sidelines like this, doing this. Now, I've singled out 5 stocks that I believe are going to benefit from this cash flood, and I'm revealing them during my live event at 1 p.m. Eastern today. Live at 1 p.m. Eastern today. Do not miss out. Click the link below to reserve your spot. Do not miss out, and I'll talk to you guys later. Bye.